Ladies and gentlemen, good day and welcome to the Q3 FY22 results conference call of Star Health and Allied Insurance Company Limited. This call is hosted by Emkay Global Financial Services. We have with us today Mr. V. Jagannathan, Chairman and CEO, Dr. S. Prakash, Managing Director, Mr. Anand Roy, Managing Director, and Mr. Nilesh Kambli, CFO. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Avinash Singh from Emkay Global Financial Services. Thank you, and over to you, sir.
Good morning, everyone. I would like to welcome the management of Star Health and thank them for this opportunity. I shall now hand over the call to the management for their opening remarks. Over to you, gentlemen.
Thank you, Avinash, and very good morning to all of you. And thank you for your time to join this earnings call of Star Health Insurance, the first earnings call. My name is Anand Roy. I'm the Managing Director. With me, I have our CEO, Mr. Jagannathan, my colleague MD, Mr. Dr. S. Prakash, and our CFO, Mr. Nilesh Kambli. Also, our Company Secretary, Jayashree, is here with us, and the Investor Relation Head, Vinod, is with us. So I would like to take you through the script of my part. I will talk about the business and the industry, and my colleague, Dr. Prakash, will talk about the claims and the other developments in the company. So thank you for joining the earnings conference call of Star Health and Allied Insurance Company for Q3 and 9-month financial year 2022. I will give you a brief overview of the industry trends and development that we have witnessed in the last few months, as well as walk you through the company performance in terms of premium and distribution. Dr. Prakash will cover aspects related to claims, including the steps that are underway to manage them. The data for Q3 FY22 reveals that there has been a momentum in economic activity underpinned by expanding vaccination coverage as well as the release of pent-up demand. The resurgence of COVID-19 infections in the form of the new Omicron variant has created some sense of uncertainty. That said, we believe that the impact of the new variant is lower than the second wave, given the impressive ramp-up in the vaccination program. However, since the number of infection is huge, even a small 2 to 3% rise in hospitalizations will lead to increased claims inflow for insurance business. We firmly believe that COVID, while being a short-term negative in terms of higher claims outflow, is a long-term positive for the insurance industry as it has and will lead to higher awareness and premium growth and increase in the penetration levels. As regards to the health insurance industry, there was 29.1% growth in health and PA business in 9 months FY22 over the same period last year, largely driven by 30% growth in group health and 99% growth in the government health business. Retail health continued to grow impressively at 17% in 9 months FY22 over the same period last year. With respect to Star Health, our GWP grew by 26.9% in 9 months FY22 over 9 months FY21 to rupees 7,774 crores. Our agency business continued to contribute around 78% of the overall business. Our agency strength has increased to 534,000 agents with an addition of 70,000 agents in the first 9 months. Corporate agents, banks, and other tie-ups have picked up, and premium has grown by 79% in this segment. We had a number of positives in the 9-month FY22, including as far as premium and distribution. We took a price rise in the flagship Family Health Optima FHO product with effect from August 21. The benefits of the price rise will flow in ensuing periods and will lead to increase in gross and net earned premium. We entered into tie-ups with banks and NBFCs, including Federal Bank, South Indian Bank, LIC Housing Finance. We have several new partnerships with distributors, NBFCs, and aggregators. Our recent initiative to grow rural business has gained traction and is growing rapidly. It is proposed to be largely digital, resulting in cost optimization. We intensified our digital initiatives during the pandemic, as evidenced by our app downloads, 1.2 million downloads, and digital policy issuances, 61% in 9 months FY22 versus 56% in FY21, same period. Online premium collection has grown by 29% and 4.2% of overall GWP for 9 months FY22. I now hand over to Dr. Prakash, Managing Director.
Thanks, Anand. Warm greetings to all of you. Shall take you through the status of claims, pricing, and cost control measures. So on the claims, the share of hospitals with a better pricing arrangement, what we call as agreed network hospital, we get advantage of cashless claims as a proportion of overall cashless claims, and this has increased to 63% compared to what it was 55% last year. We have initiated the process of identifying hospitals called valuable service providers to help our valued customers to get hassle-free medical attention and quick processing of claims. We stepped up our teleconsultation. We call it as Talk to Star. There were 6 lakh consultations done so far, and we have clubbed the wellness program along with that. Talk to Star cut claim cost by giving customer access to experienced doctors for second opinion and also alternate medical solutions. It helped us a lot during this COVID-19 pandemic. We had a COVID helpline, and we were able to promote home quarantine and outpatient treatment for most of the milder form of diseases. In general, we have raised 2,000 crore INR through the IPO in December 21, and this has boosted our solvency. Our investment assets have grown to INR 104 billion versus 68 billion in FY21. The combined ratio for 9 months of FY22 is 125%. The rise in the combined ratio is on account of the elevated loss ratio at 94%. This high loss ratio in health segment is also experienced by other insurance players, general insurance players, and standalone players. There are several reasons why the loss ratio has increased. In the 9 months FY2022, claims ratio would have been 66.5% without the impact of COVID-19. The cost of essential medical devices and supplies for the COVID-19 outbreak, such as personal protective equipment kits, RT-PCR test costs, all these things have resulted in higher claims cost. Medical inflation is a serious issue which the entire healthcare ecosystem, including all insurers, are planning to come together and address. High Q3 2022. Q3 is seasonally a high loss quarter due to the post-monsoon impact from infectious diseases such as dengue, malaria, chikungunya, typhoid, and others. The impact in the current quarter is more severe compared to previous years and 56% higher than Q1 of 2022 and Q2 of 2022 average number of claims. Elective surgeries, which got deferred and postponed from Q1 and Q2, were higher in Q3 by almost 33% in terms of number of claims compared to the H1 average. Claims in Q2 to FY22 were settled based on, I'm talking about COVID-19 related claims in Q2, were settled mostly based on ICMR guidelines and guidelines issued by All India Institute of Medical Science. State health authorities and advisories were also involved, and we have taken the guidelines of health authorities in settling most of the COVID-19 related claims. However, customers have raised grievances, and also regulator has issued advisory at industry level for the settlements to be done. In the light of these developments, additional claim payments were made in Q3 2022 to the tune of 235 crores, which adds a negative one-time impact on the claims ratio for Q3 2022. There are several steps that we have taken and can further take to reduce the loss ratio, including pricing and premium increase. There are natural inbuilt stabilizers in the product design which are linked to the age of the insured person and automatically result in a rise in the premium. We have also filed new products with higher prices. We are also preparing to approach the regulator for a price hike in our existing products on similar lines to what we did with our family Health Optima product. Increasing the average sum insured will also result in a higher premium and thereby lower loss ratio. Our proportion of retail business with sum insured of 5 lakhs and above has increased to 64% for the 9 months of 2022 compared to 57% in the previous year 2021. On the claims control, our exposure in group policies, typically high loss-making group policies, we have made some changes. This is going to be based on a risk-based pricing framework going forward, and the plan is to give up accounts where the pricing is not adequate. The SaaS fraud module that will be operational from Q1 of FY23, we expect a range of 1% reduction in loss ratio to start with. We have started to see reduction in the surgical and infectious diseases claims in January 22 and the early part of February 22 compared to what we saw in Q3 of last year. COVID-related cases in January 22 and February 22 had lesser hospitalization in terms of number of days, lesser need for ICU stay, and lesser oxygen requirement. And thus, the average claim phase compared to second wave is much lower. All in all, our focus on the attractive retail health segment continued during this quarter. We strengthened our distribution reach and intensified our digital initiatives both in sourcing and servicing. While our loss ratio rose in the period due to the pandemic and several seasonal and unique one-time factors, we have taken a number of steps to manage it going forward. We continue to believe that we will overcome the transient challenges posed by the pandemic and emerge from it well placed to take advantage of the opportunities that lie ahead. Thank you all.
Thank you. Should we open the floor for Q&A session now?
Yes, we can do that.
Thank you very much. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harish Kapoor from IIFL Asset Management. Please go ahead.
Hi, sir. Thanks for the opportunity. Couple of questions from my end. First is this 235 crore that you kind of spoke about as one-off in Q3. Could you talk about what's it all about? I do understand regulator had put out a notification stating that some of these claims should be, met. But other than that, do you have some buffers even around, wave 3 by any chance? Because January you mentioned that the surgical part is lower, obviously because wave 3 was going around in January. So maybe there will be a bounce back eventually. But do you have buffers or some other provision for wave 3 as well? And what was the impact of wave 2 overall in terms of some of the numbers in Q3 overall? So that's the first question.
Yeah, the impact of COVID in Q3 was still there. The tail end of pandemic still continued in Q3, and we did get to see close to 4 to 5% of claims arising out of COVID-19 in Q3. And in Q2, some of the claims we may have to reject because most of the claims that happened as the avalanche of claims that we got in Q2, some of them were due to anxiety, some of them were young people with no comorbid factors, and the need for admission is not as justified by ICMR guidelines. So based on that, we have to reject such claims. But unfortunately, some of those claims came for a reconsideration during Q3, and we have to open those claims and pay as a one-time impact. That happened in Q3, and that's what we meant that 235 crores.
And do you have buffers for wave 3 as well? Anything built into the numbers, or that impact will come in Q4, if any?
In terms of buffers, we have increased our IBNR provisions by 44 crores in Q3 to take care of some of these things. But as Dr. Prakash sir mentioned, the Q4 or the wave 3 impact is much lower. The average size of the claims is lower on account of lower hospitalization, as well as the need for lower ICU as well as oxygen requirement. So we see that things are starting to normalize. I mean, that's what we see in the first 45 days.
Okay. And two other quick ones, if any outlook in terms of loss ratio normalization. And second, what is your thought around capital requirement now? Obviously, your solvency ratio is around 180%. Do you have any internal number which you don't want to go below? Because Q2 obviously was around that 150% mark. A lot of other companies do have buffers like 160, 170% below which they don't want to go. You are at 180% right now. So how do you see that shaping up, and do you need to come to the market again next year to raise capital?
We believe that currently our solvency ratio has moved to claims because the claims are on limited levels. As we keep on seeing the impact lowering, we'll move to premium, which will give us a release of 15 to 20 basis points in solvency. Yes, we do have a internal threshold of around 1.6 levels below which we'll have to look at options. But whatever our projections see, we don't see the need for the capital requirement for the current year as well as the next year as well. So we are pretty confident that we'll be able to manage with the existing capital base.
So maybe in FY24 first half, you might have to kind of relook based on the growth trend and your internal number in terms of solvency part.
Yeah, so capital, we have two options. One is, we have the option of subdebt also with the increase in capital base with profits coming in. That's an option available, but we don't see the need for next year as well. Be it 23 or 24. As the profits keep on coming in, business starts to normalize. We should be pretty comfortable in terms of solvency.
Sure. Sir, and the first part that I was checking on in terms of loss ratio normalization, how should that shape up in Q4 or the way ahead?
We have already started seeing reductions in the first 40 days, and we believe as things start to stabilize, the vaccination program further increases, and the measures that we are taking, it should be a normalized loss ratio for the next year.
To supplement what our CFO told, and Jagannathan, if you are looking to our figures, without COVID, our loss ratio is only 65%. So that will give us a good scenario for us to carry on. And as you could see, our growth, more so in market, is very, very high. I think we are number one in India. So among all the general insurance companies also. So there will not be any necessity for raising additional capital, and we are confident that things will settle down.
Sure, sir. Sir, and last thing, just any outlook around growth, if you can talk about that, will be helpful. That's the last one.
So the growth of the company as on Q3 FY22 has been 27%, as I mentioned in the opening remarks, and we are seeing good growth in the retail segment. Our accretion in retail segment is the highest in the industry with more than 40% market share in the accretion. And we are more focused on building the profitable retail business, and that is what that will continue to be our agenda going forward also.
Sure, sir. Thanks for answering my questions and good luck.
Thank you very much.
Thank you. Sorry, thank you. The next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, good morning, everyone, and thanks for the opportunity. Three questions. Firstly, if I look at the slide 7, our combined ratio for 9 months, even if I exclude the COVID impact, the one time, it still comes at 97.5%. And therein expense ratio also have a role to play if I look at the the numbers pre-COVID and pre-21, pre-IPO as well. So can you talk about when can we expect a normalization of this to 93-94% levels, which were the levels pre-COVID? And you did talk about, Dr. Prakash did talk about medical inflation seasonally and seasonally high on cost ratios. So what kind of trajectory do we see maybe over the course of maybe FY23, 24, if you can provide some color?
So going forward, without the impact of pandemic, we foresee that there should be a lot of standardization that's going to happen in the healthcare sector, because a lot of awareness has reached through the media, and there is going to be a control on the hospital costs. So we expect that to happen in the upcoming quarters. And insurance companies have also grown much stronger in building their systems, process, and asking the right questions. So this pandemic has enhanced our resilience, and definitely post the pandemic in the healthcare space, I foresee that a good reform and transformation happening, which should be able to help the healthcare costs not only on infectious diseases but also in other areas.
Okay. And did I hear it right when you said that the claims ratio is going to decline by 100 basis points in 4Q versus 3Q?
This is a forward-looking statement, but what I can see is the first 40 days of this quarter, definitely we see a very positive response, because the number of claims reported per day used to be around 6,500 plus. Now it is less of 5,000 since past few days. Now there's a very positive trend. We used to give enhancement close to 3,700 to 3,900 claims per day, but now it has dropped to 2,500. And the number of high-value claims, more than 1 lakh claims, used to be around 950 during the peak of the pandemic. Now it is around 500. So what I'm trying to say is the number of claims and the average pay per claim, both we have seen a decline in these 40 days of the Q4. So, for example, COVID-19, the average we paid in the peak of the pandemic more than 100,000. But now it has come to 62 in January, now 60 in the first 10 days of February. So this progress, the trend, we could see a progressive decline in the number and in the severity.
Okay, got it. And one question on the renewal ratio. If I look at slide 6, again, when we disclose the numbers for FY21, it was 98% on value, 92% on volumes. When I look at the 9 months, it's 93%, which has come down significantly on the renewal side. Can you talk about what's driving this, and do we expect a recovery in this over the course of the next few quarters?
So the renewal retention by value has come down. That's for two reasons. One is last financial year we had a reasonably good amount of COVID-related products which have not renewed, because we have taken a price hike in those products because of the high loss ratios on those products. So those products have not got renewed. And also we have seen 95% renewal retention in 9 months of FY22, excluding those particular products. So we are aiming at between 95 to 98% retention as our target, and we are confident we will be able to achieve that.
Okay, so historically it's been in that range, because I understood it was around 97, 98. So we are comfortable with 95 to 98. That's a key message.
This year particularly because of the last year's COVID policies impact.
Okay. Lastly, on the capital side, again, solvency at 1.8, very close to that 1.5 regulatory minimum, and 1.6 with the internal threshold. When we look at the growth trajectory, we are probably targeting 20% plus growth. The ROE, the best case we have seen historically is around 18%. So when I put all of these things together, does it imply that the capital raise is going to be more front-loaded versus expectation of FY24?
See, there are two things. One is, as I explained, we have moved to claims-basis solvency as we speak. But as we, the loss ratio stabilizes, we'll move to a premium-basis solvency, which will give us a release of around 20 basis points. And with the profits coming in, with the various measures that we take, confident the need for capital will not arise. See, one more thing, if you have to give an indication, the reinsurance arrangement that were cancelled, whether clean cut TT-based reinsurance arrangement, there is still an option to do some 5 to 10% of risk-basis reinsurance arrangement, which can give an minimum relief on capital requirement.
Yes, I am Jagannathan here. CEO, that would be the last resort. We are definitely sure, rather hopeful that there would not be any requirement for to deal with the declining solvency ratio.
Okay, great, sir. Thank you, and all the best.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. We would also request participants to limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Utsav Gogirwar from ICICI Prudential Life Insurance. Please go ahead.
Thanks for the opportunity, sir. I have a few questions. Firstly, as per your initial remarks, you have mentioned that we have taken a price hike in flagship product and now plan to take another price hike in remaining products. So I just want to understand how much price hike we took in flagship product and how much we plan to take for other products. Number one. Number two, on these lines, because of COVID, is there any change in the pricing strategy for us? Do we plan to increase the prices on a regular basis, or we will continue to do what we used to do before COVID?
Please understand that what my colleague suggested is contemplating. But contemplating need not assure that we are going to do it in our flagship policy. As we have told you, the increase in claims ratio is a one-time incident which the entire world and also our country and our company has faced in proportion to other insurance companies who have underwritten this health policy. So I would prefer that I would mention that the price rise which we may ask may not happen also. It would depend on how things move in coming months and also first quarter, 1. 2, generally we have filed certain products which to the regulator taking into all the relevant factors. COVID is a one-time incident which cannot be taken as a main factor to fix your price rate. You are also in the insurance industry, and this must be very clear. So the price fixation as such depends on various factors such as medical inflation, then the covers that you offer, what would be the expected banding cost depending on your past experience, etc., etc. COVID is a one-time happening. And you are aware that regulator has allowed all the companies to raise 5%. Of course, the Star Health has chosen not to increase it for our own reasons.
Yes.
You want to supplement, Anna?
So just to add to what Mr. Jagannathan said, our flagship product FHO, which you mentioned about, we took a price hike in the month, and it is effective from August. So we had taken about, on an average, around 15%. So we do go to the, obviously, as you know, the price revisions of all products have to be filed with the IRDAI and giving proper justification and reasons for attempting for price rise. So as Mr. Jagannathan mentioned, that is not the first line of strategy. That is something that we will keep on evaluating and do it as and when necessary.
Sure. So my second question is with respect to the channel-wise growth. So if you look at within channels, direct channels growth is just around 19% on a YOY basis. So this includes the sponsored health agency force. What does this direct channel include? That is first. And secondly, related to channel-wise, can you break down the growth of, corporate agent, banks and others, and web aggregators, how it has grown?
Yeah, so agency continues to be our largest channel and is growing around 25% on a YTD basis as of 9 months December. Our other channels, bank assurance, digital, and the online aggregators and all of them are growing at much faster pace. Because the base effect is there, they are on a smaller base right now, but we are also investing a lot in these additional alternate channels. But having said that, agency will continue to be our mainstay channel, and we are working to improve the productivity of the agency business. You have to look at our accretion on the overall market business that we do, retail market business, and our accretion percentage is more than 40% on a YTD basis, and that is something that we will keep on improving.
So just one clarification on this. So sponsored health agency force will be classified under agents or direct channel?
They are classified under agents.
Okay, sure. And sir, next question is with respect to the geographical trend. So can you talk about how is our premium mix in say top 8 cities and beyond top 8 cities, especially tier 2, tier 3 one, and how is the loss ratio behavior geography wise?
So the top 8 cities, in terms of premium contribution, you're asking?
Yes.
So the premium contribution from the top 8 cities, as per my last estimate, was around 50%. And as far as loss ratios are concerned, definitely in the metro cities, the loss ratios are on the higher side as compared to the other semi-urban and rural markets and even tier 2, tier 3 cities. The exact numbers we will be able to share with you, Dr. Prakash will share with you. But Dr. Prakash, maybe you can.
So the number of claims, if you look at the number of claims, actually in geographies like Delhi and Pune, we are seeing an increase in the number of claims. But whereas the average that we pay for a claim, it is more in Hyderabad and Mumbai. So we do a constant study of geography-wise, what is the increase in number of claims and what is the average that we pay and what is the behavior of the hospital. So area-wise, geography-wise, we have people to handle these claims. So they are aware of the local trend and they can take the right call.
Sure. So just last question from my side. As per the presentation, 63% of the premium value is issued digitally. So what does it digitally mean? Like there was no intervention of agents, or can you just define this?
So digital, what we have, can you repeat the question? What did you say?
So 63, in the presentation you mentioned that 63% of the premium is issued digitally. Right. So I just want to understand, this is without any manual intervention, or how does it work? What is the definition of this?
Yeah, so you're right. Digital issuance means the fulfillment happens by the customer himself or herself, but it can be through our virtual office platforms, which are being offered to our agents and other distributors also. So basically, the agents are now empowered to do business digitally, wherein they can fulfill the customer's requirements on the virtual office platform and send the link to the customer to make the payments, and of course fill the proposal form by the customers themselves.
So all the businesses done, a majority of the businesses done through agents will be classified under digital channel, through digital. Is that right way to understand?
No, that's not right. sourcing, digital issuance is different from digital business. Digital issuance is where the agents are involved and other distributors are involved. Digital business that I mentioned is only what happens on our direct digital platforms like our website and our mobile apps and all of that.
Sure. Thank you, sir. Thank you so much.
Thank you.
Thank you.
Thank you. I would request members of the management to come a bit closer to the phone. Thank you. The next question is from the line of Prakash from Motilal Oswal. Please go ahead.
Yeah, good morning, everyone. So just a few questions. Firstly, could you throw some light on how the non-COVID claims severity are there between the pre-COVID and the COVID part, and the things related to a mandatory COVID test even for non-COVID claims or PPE kits or any of those things which possibly can go away, once the rules change. How do you see that happening on the non-COVID claims going ahead?
Yeah, with regard to non-COVID claims, we can look at it as claims due to surgeries, which are elective and emergency, then claims related to infectious diseases and acute medical emergencies, and then trauma and other orthopedics. Like in our analysis, we looked at all these claims. And non-COVID claims, the biggest burden for us is surgery. But in this year, what we see is most of those deferred surgeries have already happened towards the end of Q2 and Q3. So the deferred surgical non-COVID claims coming in future is remote. And infectious diseases, usually it follows the monsoon. It is a seasonal effect. And that happens during August, September, October, November. That's the season. And now we are away from that monsoon season. Trauma and emergencies, there are it happens but in general, we are seeing year on year there is a decrease in the number of acute trauma and emergency cases. So on the non-COVID factor, if we see the majority of the cases that is relating to surgery and infectious disease component have already been attended in the first 3 quarters. And in the Q4, the 40 days of this quarter, we don't see any acute increase in number of surgical claims or infectious disease claims. COVID is coming down. Due to the Omicron, we had some close to 10% of the claims due to Omicron. Apart from that, non-COVID, every factor on the emergencies, on the elective surgical, on the infectious disease, every area we are seeing a decline in the first 40 days of this quarter.
So my question was more on the severity part, where per claim amount between pre-COVID and currently have. So how has the claims ratio on non-COVID claims moved, and whether that can decrease going ahead?
So the severity is decreasing. You are rightly pointing out, during the peak of the pandemic, it used to be around 71,000, 68,000 per claim. But now for January, we see that around 53 to 54,000 rupees. So meaning that the average we pay for a claim has sizably come down during this January.
Okay. And so with regards to your growth, if I look at the last few months data, we have been growing much lesser than the other SAHIs. So any thoughts there? Whether post this capital infusion we can grow faster, or is it a conscious strategy to grow around the current levels only? So what would be your thoughts there?
Yeah, so our growth on a YTD basis is around 27%, close to 27%. And our growth is now driven by retail business. We are looking at the quality of growth more importantly than just the growth number itself. So we are focusing more on the retail side of the business. And apart from the agency business, the growth of our alternate channels like bank assurance, digital, rural markets that we have now started exploring, these channels are growing at almost double than our company's growth. And when you compare to the industry, you have to look at the base effect. Star Health has more than 55% market share in the SAHI space. And on that base, if you look at our accretion, we are able to maintain a very healthy accretion of more than 40% on an industry basis. So I think it is not comparable, but we are more focused on the quality of growth rather than quantity.
Okay. Got that. All right. Yeah, that's it from my side.
Thank you.
Thank you. The next question is from the line of Anand Bhavnani from White Oak Capital. Please go ahead.
Thank you for the opportunity. I have a couple of questions. The first question is on the claims ratio. Now, if I adjust for the 235 crores of one-time COVID claims, our claim ratio instead of 104 should be around 95.25. But then this will also include some surgeries, elective surgeries, which were kind of bunched up in Q3. So if you can give us some sense of, what would be the excess bunched up services. So I just want to understand what would have been the claims ratio in Q3 adjusted for these all distortions, and if you can give us some sense of the distortion due to bunched up elective surgeries.
To answer this, it's very difficult to do an answer for Q3 because Q3 itself is distorted. Q1 was COVID, Q2 was again part of COVID, part non-COVID, and Q3. The good part will be to look at the YTD number. The YTD loss ratio is 94%. The COVID impact of it is around 27%, and excluding the COVID impact, it is around 66.5%. And as sir had mentioned, 66.5% also the non-COVID claims has an impact of excess inflation on account of all this RT-PCR test, PPE kits, all these things. So we believe as COVID keeps on coming down, the impact of inflation on severity will come down, and we should look at those normalized loss ratios. Again, the group health loss ratio has been higher during this period, and we have taken conscious calls to reduce the group health portfolio as well. So all these factors will contribute to the pre-pandemic loss ratios as we keep on moving forward.
To add to what our CFO said, I'm only elaborating. The COVID has not only had and Jagannathan had a direct impact, it also had an indirect impact. That is what we mean in all claims. See, you can recall, even the hospitals have put beds in the platform and started treating the patients. And whatsoever be the type of treatment, disease for this treatment is offered to, they have used this PPE kit, etc., which has added to the claims cost. So you have to divide it into two, COVID as such, and other than COVID, the impact of COVID on those claims. Thank you.
Noted. And sir, secondly, just wanted to understand, when you're pricing policies, are you pricing with a long COVID kind of assumption whereby the thesis is there will be still some waves maybe of minor intensity, but it's it's not over yet? Or are you pricing that it's over? So what is our current pricing strategy? What are the underlying assumptions?
Sir, Jagannathan again, one-time incident can never be a continuous incident. If that happens, the entire world will perish. So you cannot anticipate COVID all the time and price your product. We price our products taking the normal situation into account. And after all, in any business, there will be a weaning and waxing period. And when a waxing period comes, it happens. But always you cannot bear waxing period, then the insuring public will suffer.
Noted. And a technical accounting query. Now, when I see the incurred claims, there are two parts, claims paid and change in outstanding claims. So this 235 swing has been accounted in which part, the claims paid part or the change in outstanding claims?
It will be part of claims paid because these claims were reopened and paid during Q3.
Sure. So now if I look at the change in outstanding claims, there is a 772 crore swing quarter on quarter. It was negative 560 odd crores, 559.8 crores to be precise in Q2. and it's positive 202.8 crores in Q3. So what explains this sharp change? Like it's a significant change. So if you can elaborate.
So two parts have contributed. As we explained, the IBNR reserves we have increased by 45 crores. And second is the infections and the surgical claims that were reported in Q3. Those parts are still unpaid as on 31st December because it takes time. So those have also contributed to the increase in outstanding. So these two factors have contributed to the increase in outstanding.
Noted. But in Q2, it seems we released 560 odd crores. So what was the reason for 560 odd crore release in Q2?
So basically, the impact was very big in Q1. The claims start flowing in, there were assessments done. So Q1, it was a pretty high claims outstanding because the claims were reported to be settled, which the settlements took place in Q2. So that is the release that you can see. Between Q1 and Q2, the paid claims had increased, which led to the release in outstanding.
Okay, I have some queries on it. I'll come connect offline. Thank you for the opportunity.
Okay.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Sumangal Pugalia from Rare Enterprises. Please go ahead.
Hi, good morning. So my question was, I wanted to understand the underlying trend which I've been observing in the retail health insurance space. The public sector insurers have been losing market share to SAHIs and private players. So I just wanted to understand on the ground execution and strategy. What are the things that the public players aren't doing that the private insurers are focusing on?
I'm not clear with your question. Can I have it again?
Hello, can you hear me?
Question again? We are not clear with your question.
We will be thankful if you can kindly repeat the question because there is some disturbance.
Yeah, so my question was, the IRDAI data suggests a trend from shift in market share from public insurers to private players and SAHIs in particular in the last 1 or 2 years. So I just wanted to understand from a strategy focus point of view and execution, what are the public insurers doing that is different from the private players?
There are two things. See, after all, the market, when a service is good, by word of mouth it spreads. I do not want to comment on the service of public sector insurers. So naturally, our portability in always increases, so also fresh policy growth also increases. That talks volumes about our service and the customer satisfaction. I would leave it at that.
Sure. Thank you.
Thank you. The next question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Sir, in the numbers, 27% growth what we see, as per the back calculated numbers, if I assume renewal rates around 90-95%, large part of the growth would have come from renewal premiums rather than coming from new business growth. So just wanted to understand, because new business invariably has a lower loss ratio, how it will play out going ahead if the mix is more made up of renewal rather than new in coming year in that sense. Basically, that's the first question what I have, and I have one more I'll ask after you answer this.
So Sanket, that's a good question, and our new business constitutes around 25 to 30% of our overall portfolio always, on the retail side I'm talking about, and we are working to improve this with the introduction of our new channels that we have introduced, like our rural markets as well as our digital focus and the new partnerships that we have with various banks. I expect that our new business contribution will only improve going forward. And as far as the renewal business is concerned, renewal business also is a contributor to the company's profitability. It is not something that we shun away, and we are definitely interested in ensuring that both the new business and the renewal business grows in a proper manner.
Okay, sir. Got it. And the second question is that you said that in the August we took a price hike of 15% on our popular flagship product. Just wanted to understand this 15% is more of a function of the general medical inflation what industry faces, or is it somewhere priced in such a manner that the losses which we made because of COVID to some extent get recouped in coming years, so we can see a sharp improvement in the profitability in coming years?
So the 15% increment in the pricing of our FHO product was taken considering the overall loss of the particular product. We always look at each and every product on a standalone basis and we evaluate, and when it is necessary, we go for a repricing. So as far as COVID impact is concerned, as our CEO already mentioned, we are looking at this as a one-time impact, and God willing, this will eventually phase out in the near, in the next few months. But having said that, we do continuous evaluation of all our products, and we keep on approaching the regulator as and when necessary.
Got it, sir. And finally, see, I was just again harping on solvency, and we are at 180 solvency. So instead of raising sub-debt or anything of that kind, the way other insurers do, getting into a risk-based proportional treaty with the reinsurer and manage the solvency, which we probably discontinued after capital gating rules came in. So just wanted to understand that internally management is thinking to revisit the reinsurance strategy so that capital efficiency of the company improves.
Yeah. See, Sanket, we have the options available. We have raised the capital. Sub-debt is an option available to us to raise capital. Reinsurance on a risk basis is an option available. If we need it, it will be available with proper approvals from the regulator.
Before to add to what the CFO says, we are not in that grave situation now. So as and when it is required, then the options will be evaluated.
Got it, sir. And finally, the question is on the draft regulation from the regulator, which speaks about time frame for existing continuous appointment of MD and CEO and whole-time directors limiting to 15 years. So just wondering, have you heard anything from the regulator? And given Jagannathan sir has already completed 15 years and already completed the 70 years of age, so just wanted to understand your view, or if you can throw a light on these things, will be really useful, sir.
No, regulator has asked the views from the public, from the insurance companies. So every India citizens would have given their reaction, and we have also given our suggestion. So as it is our company, according to SEBI regulations, there is no problem because I'm answering, Jagannathan is answering. So I'm not holding the two positions, chairman and CEO. So chairman, it has already been bifurcated. Chairman has already been bifurcated. So this has to go through various stages. Number one, this has to go to the Insurance Advisory Council. Then there will be further round of discussion between the government and the IRDA. And the final rule comes, we as a citizen and also a company working under the control of IRDA will follow it. So I hope my answer is clear to you.
Yes, sir, it's clear. Just thinking from in a worst case scenario, succession planning in that sense. Basically, that's the only reason I was asking that question, sir.
As you would have read, we have got two managing directors.
Yes.
And one among them will take charge as the company's head.
Got it, sir. Thank you very much. That's it from my side.
Thank you. The next question is from the line of Rahul Jha from Bay Capital. Please go ahead.
Thank you for the opportunity. So my question is this ADA order on payment of claims, was it specific to us? Because none of the other insurers who have reported results, all of them have a lower loss ratio in Q3 as compared to 9 months. Ours is the only one which has reported. For example, ICICI Lombard 9 months COVID claims is much lower than the total Q1 COVID claims. So all of them have seen releases, and we have seen another one of 235 crores. So was it specific to us, the order?
Look, the order is at an industry level. And because we have higher proportion of retail claims, the impact for Star Health comes to be on the higher side compared to other players who have a higher contribution of group business. And what we can see is, between Q2 and Q3, even for other insurance players, the loss ratio has increased. So that's a trend between Q2 and Q3, which is experienced by all the players, including Star Health.
No, for the 9 months, I'm saying 9 months, our claim ratio is on an overall basis is much lower as compared to Q3. But others, the situation is completely different. Even Aditya Birla, which has reported, which has a higher retail as well, their ratios are not very different from other insurers.
See, the Sahil players operate on a 50% URR method. So those ratios are not comparable to what Star Health is reporting. We are reporting on 1 by 365 basis. On a 50% method, a higher business growth will give a higher earned premium, and the loss ratios will not show a true picture. So the comparable numbers will be GI players with health business having 1 by 365 basis account.
Okay. So can we see another backlog claims on COVID in Q4 as well?
So Q4, we have already experienced 40 days in Q4. And in these 40 days, our ICR is around 74%. So naturally, beyond this, we don't expect any overflow or spillover of claims from Q2 and Q3. So I think that spillover and whatever is we have faced and we have sort of managed. And in these 40 days, our ICR looks to be around 74%.
Further to add, whatsoever claims which are yet to be processed, you must be knowing the insurance system, we provide. So that has already been provided, and so there is no question of any expectation of any claims being reported.
Right. Thank you.
Thank you.
Thank you. The next question is from the line of Swarna Mukherjee from B&K Securities. Please go ahead.
Yeah, thank you for the opportunity, sir. So my first question is on the loss ratio side. So in the presentation, you have mentioned that there is this 27.5% adjustment impact coming on the loss ratio because of multiple factors. I just wanted to understand the impact that is coming from the change of URR accounting to 1 by 365. So if you could just share that number, sir.
So the adjustment for last year up to March 21, for the 1 by 365, the withdrawal of reinsurance treaty. For the current 9 months, there are no adjustments, and what is the impact is only on the account of COVID. So 27.5% is the COVID impact for 9 months. The URR impact, the reinsurance impact was for last year.
Okay, so this 66.5% includes basically the impact of the change in the accounting policy. That is the correct way to look at it.
Yeah, so change in accounting was done last year, and now we are on 1 by 365 basis accounting. So there is no impact of this in the first 9 months. The first 9 months only has an impact of COVID. So 94%, 27.5% is the COVID impact, and other than COVID, the loss ratio is 66.5%.
Right, sir. So the reason why I asked the question was that this 27.5% what you have, this is the exceptional COVID claims impact that you said, right? That 235 crores. Would that be correct? Or is this the overall total extra COVID claims?
So overall total impact is 27.5%. We had a total impact of, on a gross basis of 2,100 crores on account of COVID for the first 9 months. And this year is exceptional.
Members of the management, we lost your audio, sir. We cannot hear you. Ladies and gentlemen, we lost the line for the management. Request you to please hold the line while we join them back. Ladies and gentlemen, we have the line for the management reconnected. Over to you, sir.
Yeah. So just to continue with the answer, the impact for the first 9 months on account of COVID is roughly 2,100 crores on a gross basis. These 9 months are peculiar in terms of the fact that there was impact of COVID, but the other than COVID claims, unlike last year, are on a regular basis. So the COVID and non-COVID is pretty standardized. I mean, the non-COVID claims are standardized as pre-pandemic period.
So, reason why I asked was that I just wanted to delineate the change in this accounting strategy to get a sense of what your normalized loss ratios could be once the pandemic is over. Because when you made the change in the accounting strategy, immediately post that the pandemic started. So, getting that color was a little difficult. So, any comment you would like to make, how much it would, like 1 or 2 percentage point, what you would add to the combined ratio?
As discussed on the call, with the COVID impact coming down, with all the measures that we're taking, we should be returning to the pre-pandemic loss ratios that we have been reporting over the period. Okay. All right. That's very helpful, sir. My second question is on the price hike in the family, your flagship product that you said. So how has been the scenario in the overall industry? How do you see the competitors? Are they also increasing prices? And what is this outcome on the competition because of that you have raised prices?
So the price hike we have taken in one product, as I told you about, on our Family Health Optima, which is our flagship product. As far as competition is concerned, we have seen most of the competitors also have taken price hikes. As far as our price point is concerned, as compared to other competition products, we are well placed and the products are competitive, and we always ensure that the products are rightly priced so that there is a mix of affordability as well as at the same time the company's bottom line is protected.
Okay. All right. Got it. And lastly, on the comment that you made on the group business, sir, about being more selective on underwriting side. So I wanted to understand, does this arise from any experience that you have received from the SME book? Because my understanding was that this was a fairly profitable business. So wanted to get some color on that.
Repeat this question again, please.
So, being more selective on the group businesses you had mentioned, so I wanted to understand how the experience has been in the SME book of late.
The group business is very, very unpredictable outcome. So every company, I can confidently say that making direct group business, what I mean is employer-employees group or etc. Other than SME group, there is always the burning cost is more than what the premium received. So we have consciously taken a decision now to stay away from group. In other words, when the burning cost is examined, not to stay away, our ratings will always be at least certain percentage more than that, taking into future inflation into account. So while doing that also, we are a company in the field for 16 years. We have our experience how to arrive at the burning cost, and that will be applied. That's all.
Okay, got it. Got it, sir. Thank you so much. That's all from me.
Thank you.
Thank you. Anyone who would like to ask a question, you may press star and 1. The next question is from the line of Saurabh Dhole from Trivantage Capital Management. Please go ahead.
Yes, sir. Good morning. I have 2 questions, and both are with respect to the web aggregators. So, could you share the exact share of web aggregators in your total premium profile? And this would obviously should also include the fintech players that you partner with. And sir, the second question is that what role do these aggregators or these fintech partners play in your underwriting, and what are the loss ratios coming from this channel versus the overall loss ratios for the company?
So the web aggregators and the fintech players combined would be contributing less than 5% of our GWP right now. But they are growing fast, and definitely some of the partnerships are long-standing, and we intend to keep them, with us. But the loss ratios specifically I'm not able to provide, but I can tell you that the loss ratios are comfortable. All our partnerships are based on mutual understanding that both the partners should benefit, and only with that logic we enter into any partnerships. So we keep evaluating all of these channels, and we keep re-strategizing as and when necessary.
Okay. And sir, how dependent are you on them with respect to your underwriting?
Most of these channels distribute our regular retail products, so the underwriting norms applicable to them is similar to what other channels like our agents and our direct channels use. So there is no differentiation in the underwriting.
No, sir, I didn't mean norms. I meant what kind of data are these players privy to, because of which you get a better understanding of the customer you are about to insure.
In terms of, can you come again on that? Can you elaborate?
No, so I want to understand, because typically these web aggregators and fintech players own these customers, and as a result they have a lot of data points with respect to each customer they want to pass on to partners like you. So I want to understand, to what extent are you dependent on those data points to arrive at the correct pricing for a particular product?
So the data points are totally shared with us. It's not that we do not have access to the customer's data. All the customer's data is available with us, and based on the information given in the proposal form, we underwrite each and every proposal, just like we do for other channels.
So do these data points actually help you in fine-tuning the price, or it doesn't help at all?
No. So we don't have a premium loading in our underwriting. We have a fixed premium for the product, and based on the data submitted to the aggregator, we have a team of medical experts also looking into the risk profile, and we understand the risk, and then we decide on accepting the cover with or without endorsement.
See, in short, to conclude, A, we have the names and details of the customers who refer. B, we do not differentiate whether it's a policy referred to the other aggregators or which is picked up by our own agents in the general market. C, all the policies go through the underwriting process, such as medical examination if necessary, or acceptance. D, the loss ratio is periodically reviewed, and generally, as my colleague confirmed, it is comfortable. I am Jagannathan. That's all. Yeah.
Okay, so if I got you correctly, it means that whatever extra data points that a particular web aggregator provides you, that doesn't make any difference to your underwriting.
There is no extra data points that they are providing us in the first place. And second thing is, we are a very large organization, and their contribution is less than 5%. So whatever data they are providing is useful, but we also have our own sets of data based on which we do our product pricing and underwriting.
Right, sir. Thank you so much.
Thank you. The next question is from the line of Anand Bhavnani from White Oak Capital. Please go ahead.
Thank you for the opportunity. Two questions. First is in terms of our solvency ratio. You mentioned that 20 bits might get released because we shift to a premium-based solvency as compared to claims-based solvency. Can you elaborate a bit on that? What is the difference, and when can we shift to premium-based solvency?
So the IRD solvency is factor-based. Premium or net return, the gross premium and net return premium, whichever is higher, is multiplied by a factor of 20%, whereas the claim is multiplied by a factor of 30%. So now whenever the claims ratio crosses a certain threshold, the solvency moves to a claims level of claims factor based solvency, which leads to higher capital requirement. But as we keep on stabilizing the loss ratio on a trailing 12-month basis, the loss ratio comes to a normalized level, we'll again shift back to the premium basis of solvency, which will release this excess capital that is lost.
Noted. And secondly, we spoke about seasonality in our business. There is seasonality due to premiums, there is seasonality due to diseases in certain quarters or elective surgeries being more in certain quarters. So hypothetically, let's assume for a full year, if X is our claims ratio that we anticipate, how would it be across the different quarters? Like Q1 would be X minus something, some percentage, Q2 would be something. So if you can give us a ballpark sense, I understand this will vary year on year, but typically, which quarters are above X and by how much typical percentage point, and which quarters are below X?
I think, can you pinpoint the question?
So if hypothetically, let's say 70 or 68 is our claims ratio for the full year, which particular quarters of the 4 quarters would be higher than these, and typically by what quantum?
See, it varies. Mostly it's Q3. See, there are also other factors play.
Noted. But given we've been in operation for so long, is there a pattern, keeping away the COVID distortion, is there a pattern typically how much is Q3 higher by the full year average?
Percentage higher and all vary from year to year. But generally, it happens in Q3 or mostly surgical claims in May and June, if it is elective like.
Noted.
There are certain months where we get more of surgical claims and certain periods where we get monsoon-related effects. And epidemics happen once in 2-3 years. Suddenly, there's a spurt of epidemics where we see, you would have read in the newspaper, you have read about dengue. Once in 2-3 years, there is a spurt of epidemic happening, affecting some of the geography. At that point of time, the numbers may increase, and that happens during end of Q2 or Q3. And most of the surgical claims happen during the holiday season like May or June. So it's not like, that the trend may not be the same every year.
Noted. And just clarifying on the solvency ratio part of the question, you said trailing 12-month, we need to bring down our solvency below a certain percentage. What is that certain percentage?
No, what I said is the claim ratio, when it falls below a certain percentage, it moves to a premium-based solvency. It is around 60 to 70%. When it starts moving on a trailing 12 months below that ratio, it starts moving to premium-based solvency factor.
Noted. Thank you.
Thank you. The next question is from the line of Abhishek Saraf from Jefferies. Please go ahead.
Yeah, hi. Thanks for the opportunity. Good morning, everyone. So, sir, I had just 2 questions. One was on the digital side. So, if you mentioned that the loss ratios that we get from the web aggregator is comfortable level. On the expenses side, if you can share what kind of commission ratios are there versus our core channel, which is the agency or other channels. Maybe if you can't give me the number, just means relatively where they stand. And secondly, sir, if I see your digital growth, so means for 9 months, like 29% growth, which is not too dissimilar to our overall growth of 27%, while in cases of many players, what has been seen is that the digital is actually growing at a certain multiple of the overall growth. So if you can just help me understand, means how are we actually, how are we taking our channel strategy, especially on the digital side? Should one expect that this should be around these levels only, means hovering around the company growth, or we expect it to actually take it to multiples like the other peers are doing? And if yes, then what are we doing behind that? Means is there any investment strategy in digital, making our apps much more refined, more feature rich, like few of our peers have? And yeah, so that was largely on the digital part. After that, I have one more small question, which I'll ask after this. Yeah, thanks.
To answer your first question, nobody can and Jagannathan, nobody can pay more than what the regulator has prescribed. So the question of paying a different amount to different persons or over and above what has been prescribed by the regulator doesn't arise at all. That is number one. Number two, with regard to the other question, my colleague will take it up.
Yeah, so coming to your question on the growth of digital, definitely this is the focus area for us. And just like our regular retail growth, you have to look at the accretion. We are way above most of the other players, even on the digital side, though there is no published data. This is what I gathered from my sources. But having said that, we are investing a lot in all the features that you mentioned, whether it is the website-driven journeys, whether it is a customer app. We have recently updated our wellness app also, which will help us in acquiring more new age customers. So the growth effect is largely because of the high base of last year, but we are also looking at the accretion numbers, and we are also tracking this on a day-to-day basis.
What would be the digital means our in-house digital share? Like you mentioned, 5% will be from web aggregator third party. But in-house apps driven or website driven sales, how much could that be of our overall GWP?
So in-house, current year, we are expecting around 4%, 4 to 5% is what we are expecting. This excludes all web aggregators and fintech partnerships. I'm talking only about our direct in-house. And this is a reasonably large number given the size of the company. But we are also looking at all these partnership channels also, and they are contributing another 2 to 3% for us.
If I heard it right, like you said 4 to 5% would be in-house, right?
That's correct.
Secondly, on the solvency part, sorry to come back again on this topic. So, pre-IPO, we were having a decent amount of our business ceded to the reinsurers to the tune of 26%, and then obviously it came down to the regulatory minimum. And now again, we are maybe entertaining the idea that if need be, we can go back to the reinsurers with around further 10% sharing. So if you can help us understand, should we in our thought process assume that the reinsurance strategy will be a bit more fluid and it will be situation dependent, or could it be more like principle, okay, we will have not more than the minimum required and manage on our own? So just from our qualitative understanding perspective, how we should look at it. Thank you.
Yeah, you are right. The reinsurance strategy will be in line with the regulatory requirements, and it will be fluid depending upon the requirement. We'll have to compare the cost of raising equity, the cost of reinsurance, the cost of subject, and accordingly we'll decide on the reinsurance strategy.
So thanks a lot. That's quite helpful. Thanks a lot.
Thank you. The next question is from the line of Ritik Tulsian from Concept Investment. Please go ahead.
Yeah, hi. Am I audible?
Yes, sir, you are.
Okay, so good morning to the management. I just want one clarification. So you said in claim ratio, 27% impact in 9 months FY22 is because of COVID. But in slide 14 in investor presentation, the note says that adjustment for 9 months FY22 excludes COVID-19 impact. So can you clarify whether it includes COVID impact or not? So that's the only question I have.
Yeah. So what it means is 94% is the total loss ratio, COVID plus non-COVID. When we do the 66.5 is excluding COVID. I mean, it's non-COVID loss ratio. COVID loss ratio is 27%. That is what it means.
Okay. That's from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Prateek Poddar from Nippon India Mutual Fund. Please go ahead.
So just one question. When I look at your ANS proportion on a 9-month basis, it has gone up from 55 to 63, yet your adjusted loss ratio has gone up from 61.3 to 66.5. How should I think about this? Hello?
The ANH component has increased from 55 last year to 66 this year. Is that?
Yes, that's correct. But yet your adjusted loss ratios, right? If I were to adjust for COVID, which you have talked about on slide 13, the adjusted loss ratio has gone up from FY21 level of 61.3 to 66.5. Now, ANH, as disclosed in DRHP and even in your PPT, has a better pricing, right? And better negotiated pricing. So that benefit is not going through. Why is that so?
The benefit is that actually ANH involves packages for more of surgical procedures. It is an end-to-end package for a commonly done surgical procedure. Whereas in COVID, it is not. It doesn't fall into any of the packages that we have negotiated with the hospital. So it came as a different scenario where there is a need for an isolation. There is a need for
your voice is, sorry, sir, your voice is not clear. I don't know, maybe it's my network.
See, the 63% that is given, it is the proportion of cashless claims. So cashless claims is 70%. 63% of the cashless claims are to the ANH hospitals. It has no direct relation to the loss ratio. It will have an impact, but that impact will not be, comparable in terms of the loss ratio reduction. 55 to 63 is like 8%. It's not a loss ratio impact. It is the proportion of cashless claims.
Regardless of that, if your ANH network is settling a higher, the mix of ANH is increasing in your claim settled. Are you saying that, or you are saying basically that the mix has not increased? This is just as a proportion of cashless. Is that what you're trying to say?
No. There is a definite improvement in terms of the proportion of ANH hospitals, as a proportion of the cashless claims that the hospital negotiations that we do. But it cannot be directly correlated with the loss ratio that you're talking about, 62% to 67%. It would have been higher, but because of these controls and the pricing arrangements that we have done higher with the hospitals,
So the basis of what my CFO is trying to talk, if you look at the average that we are paid, our averages are much less than industry average, meaning that we are able to get a better pricing arrangement. It is not only for the surgical procedures. ANH involves a lot of components. It is arranging a package for a commonly identified surgery. It is also fixing the room rent in a hospital which does more of medical management. And also some of the hospitals, they do a lot of investigations. This thing, we have common investigations, we fix the price. For professional charges, we fix the price. We get some discounts on pharmacy. So there are so many components in there. Some of the components will work for a medical admission and some of them can work for a surgical admission. So that is the overall, it's very difficult to measure the exact impact, but overall impact is that our average pay per claim is much less. And that is the outcome of the price negotiation and the arrangements we have with the hospital.
Quantify that amount, sir, on a YOY basis, just to appreciate this phenomena. Because in your DRHP, you were it was very clearly mentioned that the increase of ANH will lead to lower loss ratios. So hence, some quantitative data will be really helpful.
Yeah, I get your point. It is a continuing activity because we have now 10,400 plus hospitals and we look at the traffic of hospitals. Wherever there is a high volume and a high value transfer, in those hospitals we call for negotiation and it's a continuing activity. And every 2 years we get a contract, we renew. So the number of ANH hospitals and the business advantage from ANH hospitals is not a static thing. Because every day there is a team of people who work on these hospitals, try negotiating and fix the price. So what you saw in DRHP to the current status, things may be different, because every month we succeed in getting a pricing arrangement with the hospital.
And so just sorry, I'm just harping on this, but when will this lead to reduction in loss ratios? Is this more gradual or this will be step? Because, since you've not disclosed this number, but some details around this will be really helpful, sir.
What we can do is we can take this offline and explain the
Sure.
I think that will be
Sure.
Thank you. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
closing comments, maybe we request our CEO to have the closing comment. And we thank you all for your participation.
From Star, we are grateful that you could arrange this conference call. And Star is an organization which is in the field for more than 16 years. And this is the first time, rather, the world has faced such a pandemic. And this will not be a factor which will happen all the time. We have to take care of the insuring public first. Second, our own investors. Third, our own employees. These three factors are always in our mind. So it is like any tabletop which is supported by three legs. Without if all the three legs are not in the place, the tabletop will not stand. So we have, I can confidently say, come out of this COVID impact, and there will not be. See, after all, we live with positive hope. If we don't hope that we will live tomorrow, we will not live tomorrow, then it's a very sad state. The world will not exist. So we definitely hope there will not be any further disturbance in the business, and we will continue to grow. We will continue to make profit. We will not face any solvency problem, and Star flag will always fly high. Thank you.
Thank you.
Thank you. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.